Welcome to Scope's Portfolio Manager Conference. I'm Manqing Sun, and today I'm delighted to be joined by guest speaker Tom Sundberg, Director of Investor Relations at GAM Investments. Tom, thanks for joining us today. Great to have you on.
Great, thank you very much, Manqing. It's very nice to be here.
So today we're going to tap into catastrophe bonds, better known as cat bonds. That is one part of the market I don't think is well understood by a lot of people and can be relatively complex. So Tom here today is really going to help us understand how cat bonds operate and shed light on how the market thrives and why it might be the time to consider adding them into your portfolio. So we will see how far we can get there. Before we begin, I'd like to remind you with few logistics. As always, we'd love to see questions come in. So feel free to type in under the section Fragen, whether in English or German. You can watch the replay on our Scope Explorer website anytime. So let's get started then. Tom, first, would you tell us about yourself and your team?
Yes, for sure. So myself, I'm Director of Investor Relations here at Vermehrt. I've been at the firm for over 3 years now. You'll see when we're going to our organisation chart that many of the people within our firm have been with us for over 10 years. Our key investment people have been with us for 20 years. So we're a very small company. So we have about 35 employees, but we're very, very stable. The really interesting fact about Vermehrt is that we've never had one key person leave. We've had 2 junior software developers leave in our 21-year history since 2001. So very, very stable team of ILS professionals. Just a quick snapshot of us. We have 8.1 billion in assets under management on the ILS side. So we manage 8.1 billion US in insurance-linked securities. About 7 billion of that 8.1 is in catastrophe bonds. It's the most liquid part of the market. It's also the part of the market that we feel most comfortable in. It has a secondary market. You can publicly trade these bonds. And the reason we like that is because many of our key employees have backgrounds in investment management. So, in terms of team experience, I'd say that we are unrivaled in cat bond investing. Many of the techniques used today in ILS investing, but also in ILS management, has been derived from many of the key people in our firm. One example is Dr. John So, who you can see on this graph here. Dr. John So is well known as, he's called the godfather of cat bond investing. He'd hate me saying that, but that's how he's sort of known in the asset class. He's been there from the very start. He started trading cat bonds back in the late 1990s through a group at Lehman Brothers. And so Lehman Brothers actually risked $1 billion of their own balance sheet to invest in insurance-linked securities. Back in the 1990s, they were very, very progressive in that regard. John actually led that group of 30 professionals, and he invested across the spectrum of risks. So it wasn't just natural disaster risks like hurricanes and wildfires. It was film finance risk. You may remember what the Y2K bug. There was a lot of insurance around that too. And after he was finished at Lehman Brothers, he said, well, there's 2 things that really interest me about natural disaster risk. One is that the need for cat bonds in the insurance industry is critical. And so there's going to be compound annual growth for many years to come. But secondly, and probably more importantly to those on the call today, is that the attributes of cat bond investing really lends itself nicely to a balanced portfolio. There's a lot of diversifying strategies out there that say they provide diversification or non-correlation to traditional markets. Catastrophe bonds, we believe, are the best non-correlated asset class out there. A market crash cannot cause a wildfire or hurricane to occur. And that's why John actually started Vermehrt. And from there, he's built out a team of ILS professionals across the spectrum. So Claudia Green, actually, our general counsel, back in the 90s, she was actually part of the law firm that created the first documentation for the first ever catastrophe bond. Catastrophe bonds exist because of the models. And so the models show where the risk is. Dr. Anchi Liu here and also Mark Linker here as well. They both were part of the team that created the very first modern day catastrophe models back in the 80s. So we're very, very proud of our experience and our team. And I'm looking forward to getting more into the details on what cat bond investing actually is and what we do.
Yeah, I think I've tuned in for for podcast on your website about Dr. Janso, what got him into this industry and what his understanding about the cat bonds. Very interesting. I recommend our audience to tune in that too. So the cat bonds are considered as a relatively niche and complex type of debt instrument. Could you start by giving us a bit of primer refresh on how they work and what is a catastrophe bond?
Of course. So just to start from the very start, the reason why cat bonds exist is because insurance companies and reinsurance companies don't have the balance sheet strength to cover all the risks that are out there in the world. So if you think of a city like Miami has skyscrapers or apartment buildings going up every month, it seems. So there's a lot of insured property risk in that city. Miami is also highly susceptible to hurricanes. And so if a significant hurricane were to hit Miami, it could cause $250 billion worth of insured property damage. Insurance companies and reinsurance companies in aggregate don't have enough, as I said, balance sheet strength to actually cover that 1 in 100 type risk. They have enough capacity to cover the smaller events. Let's say it's a category 3 hurricane or a category 2 hurricane, but they don't have enough to cover the 1 in 100 year event. And so that's why cat bonds exist. We exist so that insurance companies and reinsurance companies, at least initially, could transfer and share in these catastrophic risks that can occur every so often. The beautiful thing, Manqing, about our asset class is that now other entities are using catastrophe bonds to help their risk spreading or risk transfer mechanisms. You can see in this diagram here, and this shows the typical structure of a cat bond, that Google actually issues cat bonds. There's not many people out there that actually know that. So Google, or Alphabet, the parent company, but everyone knows them as Google, they have a lot of buildings in California. So they've got their headquarters, they've also got their data centers. Those structures are in the way of an earthquake. So if a significant earthquake were to occur, it could cause Google billions of dollars of insured property damage. They actually issue cat bonds to help transfer that risk. The insurance companies out there and the reinsurance companies out there, they would love to have a client like Google, but they can only cover up to a certain amount of damage. That is why Google has actually tapped the cat bond market. So, just on the structure here, and we'll use Google as an example. Google chooses to issue a cat bond. A specific SBI is created, a special purpose insurance vehicle is created. That acts as, call it the umpire between the sponsor and the investor. When we choose to invest in Google's bond, our money goes into the collateral trust, which you can see is the pink box there, and it stays there for the duration of the bond. So let's say it's a 3-year bond that covers for a significant earthquake. We will collect both the investment return from the collateral, plus Google pays us a spread on top of that. So it might be a 10% spread on top of whatever we earn from the collateral trust. The beautiful thing about the structure of this is that it's bankrupt remote. So let's say, and it'll be a very rare occurrence, let's say Google actually goes bankrupt. It doesn't even have to be from the earthquake. Let's say it goes bankrupt just from malpractice, or it gets a fine that it can't pay. We're actually insulated from their bankruptcy. They're bankrupt remote notes. And so if Google goes under, all that happens is the SBI, who has an independent board, sells down the collateral in the collateral trust and returns the money to investors. Now, of course, let's say it's a 3-year earthquake bond. If an earthquake happens and it causes enough damage for our bond to pay out, then the collateral trust gets paid down and either partial or full payout goes to Google. And that payout helps Google rebuild its headquarters, rebuild its data centers, and so on and so forth.
So it's a main type of insurance-linked securities that traditionally transfer, I would say, certain degree of risk against natural disasters from sponsors to investors. What are some of the characteristics of cat bonds that investors should be aware of, when considering them into their investment portfolio? Could you compare cat bonds to other debt market financial instruments such as vanilla corporate bonds or straight high yields, especially from the risk perspective?
Yeah, exactly. So I guess the key selling point is the diversification benefits. And so that's why we see a lot of investors use catastrophe bonds. One of the things that is really interesting, so when we actually go through the modeling of each and every catastrophe bond, it provides us with a default rate, just like you'll get if you invest in a corporate security. And so catastrophe bonds in a portfolio of catastrophe bonds, they typically have a default rate of around 2.5%. So that is actually equivalent to B or double B rated corporate paper. So we have the same risk as those type of securities. What we're getting paid at the moment is nearly triple the portfolio spread on top of that corporate paper. So imagine the really interesting thing back in the 2000s when it was just John So and Nelson So going out there and trying to raise money from investors. Their elevator pitch was actually, why not replace 1 unit of B or double B rated corporate paper with a unit of catastrophe bonds? You'll instantly get better diversification within your portfolio and get paid better. So that was really the elevator pitch. And based on that elevator pitch, they were able to raise $1 billion. They often joke they didn't need people like me, like investor relations. They could just run through the actual structure of cat bonds and how much yield they can provide on a risk adjusted basis. And the fundamental story was so strong that, again, they didn't need salespeople like myself.
Okay, so we are now at Q4 already, 2022. I guess it's fair to say that it's been indeed a very interesting and challenging year for investors across asset classes all around the world. So would you set the scene for us about what's going on in the market right now and how are they impacting cat bond sector? How do cat bonds in general perform in this market relative to other generic bonds?
Yeah, so if you had talked to me maybe 2 months ago, it was looking really fantastic. So we were one of the few asset classes out there that had a positive return. We were totally unaffected by the volatility, both in equities and fixed income. It's also important to note when I talked about the structure, so I'll just bring this back up here, that these are floating rate securities. So we're also unaffected by interest rate rises. When we have our proceeds invest into the collateral trust, that's actually going into 1 or 3 month treasuries. So any increase in interest rates and therefore short-term yields actually benefits us. We get the return from that in USD in USD versions. So that's one real positive. Again, we were really having a fantastic year, but of course we had a hurricane. We had Hurricane Ian. So Hurricane Ian made landfall on the 28th of September. It was a significant event for our asset class. It was an event that had our portfolio down about 6%. So that's quite a large number for our portfolios. It's the largest drawdown we've had in the history of our firm, our fund. And so what happens after a significant event like that, it's just like your car insurance. You know, you might get into an accident and you're all safe, you're healthy, you haven't been hurt, but what happens to your premiums the next year? They go through the roof. The same thing happens with catastrophe bonds and catastrophe investing. After an event, and we had Hurricane Ian again in September, we have seen spreads in our market skyrocket. And they've skyrocketed already from a pretty high level as well. So we're at 10-year high levels in spreads before Ian. After Ian, we're actually above 10% for cat bond spreads right now. So the market opportunity for those that are considering an investment, I don't want to sound too over the top, but you know, if you know Fermat, we don't speak in this type of language too often, but this really is some of the best investing conditions we've seen since the inception of the asset class. And you can see, look, going back to 2001, this shows actually the Swiss Re cat bond index spreads. You can see that it normally hovers between 400 to 600 basis points, but in times of disruption, it tends to peak up. Right now, you can see that we are at a high level even after the GFC and also after Hurricane Katrina. So really a really special point in our asset class. Of course, for some of our investors, they've had a hit to their performance. We think for the yearly performance, we might be down around 4%, which we're very disappointed about. We wanted a positive return this year, but the forward-looking return prospects are very, very attractive.
Mm-hmm. So I guess from another point, for the past few months, both stock and bond markets are driven by the same forces. We're talking about inflation and rising rates. But I guess cat bonds are somehow less correlated by those two factors. Investors are looking for diversification, for decorrelation. So in this context, in the context of asset allocation, how could cat bonds help in that sense?
Yeah, they're definitely uncorrelated to traditional equities and bonds. Something that we contend with a lot, particularly with large investment consultants, is because of the characteristics of catastrophe bonds. They have a very low correlation to most all other asset classes. And because cat bonds actually pay quite substantial spreads, if you put it into their optimizer, it actually tells them to allocate around 10 to 15% into catastrophe bonds, which we know is not realistic. We know that many clients are not going to put that much into our asset class. So we do see investors, as I mentioned, normally take a little bit away from fixed income. They might take a little bit away from equity as a real hedge against those factors. So it's a hedge against volatility in those traditional markets. When it comes to interest rates, as I mentioned, these are floating rate securities, so any interest rate movement is not felt in our market. Inflation's a bit of an interesting one. Inflation does affect our risk in our portfolios. So if you think about it, our big risk is property being damaged. And so when property gets damaged by a hurricane or an earthquake or a wildfire, we need to pay for the rebuilding costs. Because inflation is occurring so rampantly, particularly here in the US, it means that the rebuilding costs have gone up. So, if you think about timber prices are going up because of inflation, but labor prices as well. So using contractors to actually rebuild has gone up. So that's one risk that we do really need to keep an eye on. We need to make sure that we are getting adequately compensated for the rises in inflation in our underlying bonds.
So the new issuance of cat bonds hit record levels last year, and we continue to see new sponsors, new government, new regions come into the market. But as climate concerns and an ongoing pandemic continue to impact the world, would you walk us through how cat bonds landscape has thereby evolved? What are the barriers of entry looking like now?
Yeah, look, it's climate change is the number one question we get asked in every meeting. Yeah. And the real question is climate change increasing faster than that's what's being priced in or risk adjusted for? And so what we like to do is actually just look at the science, and we look to the IPCC, which is the the Intergovernmental Panel on Climate Change. We actually believe that they're quite aggressive in a lot of their findings. They're quite activist, but we're happy to use them as a baseline. And so as it pertains to our specific risks, the science is actually quite interesting. So you'll see here, going through the most recent report back in 2021, hurricane frequency, as per the scientists in the IPCC and as per their simulations, actually show that under a 2% global warming situation, hurricane frequency is unchanged. Now that's from a person that has not been involved in ILS previously, that was quite a surprise to me even. But if you think about the science, it does come back down to basic physics. So as these scientists do simulations, they warm up the world, they warm up the globe. As the globe warms, it actually warms in different parts faster than others. So it actually creates turbulence and wind turbulence. And so as the world warms at a pretty steady level, that wind turbulence is an inhibitant to hurricane formation. So even though that we believe the IPCC does try and make the statistics look a little bit more alarmist, even they can't make frequency go up. So that's the first point. Now, hurricane speed is expected to increase by 5% by 2055. The reason for that is that the water is getting warmer. Warm water is very good for hurricane intensification. And so we believe 5% is a reasonable number. And the other thing that we look at is hurricane rainfall. And so that's expected to rise by 14% by mid-century. So, it's not nothing, but it's quite incremental and it's over a long time period. The reason why rainfall is expected to increase is because humidity. So the more humid the world is, the more the clouds can hold the rain, and that's where the rainfall actually comes from. So we're okay. We're actually okay with that. So let's say put 5% and 14% together. Let's say that our risk is increasing by 20% by mid-century or 2055. And this is a little bit of a hard slide to read, but this actually shows back in 2006 a catastrophe bond investor presentation. Back in 2006, we were actually doing sensitivity analysis on our bonds. So what this is showing is a subset of 4 different classes of hurricane bonds, and it gives a base case expected loss. So that's the second last column. It also gives a sensitivity case expected loss to show, well, let's take into account a lot of these climate change factors. You can see that we've actually been increasing the risk as a market by 38%. This is the last column, by 38% all the way up to 71% based on climate change simulations. So although the science has recently come out and said, okay, we think it's increasing by 20%, the cat bond market since 2006 has been actually factoring these situations in for, well, how long is that? Nearly 17 years now. So that's one thing to think about. The other important thing that we just remind investors about is that we're taking the risk into account, but it's also about the spread. So on a risk adjusted basis right now, we are getting paid. So this is the expected loss here, which is about 200 basis points. We're getting paid nearly 5 times the default rate or expected loss as per the models, which do take into account climate change. So climate change is, it's very, very real. It's just all ensuring that we're getting paid adequately for it. Oh, Manqing, I think you're on mute.
Oh, sorry for that. So I guess it's a good segue leading to our next question, because you're talking about pricing mechanism assumptions. I think investors are also curious about the pricing mechanism given the nature of cat bonds, which probably requires a lot of special expertise on modeling probabilities, setting assumptions, and forecasting impairments and costs in the event of natural disaster, even more so than other asset types. How do you evaluate cat bonds? What's your view on the current valuation level of the market?
Yeah, so we have a team of scientists and modelers within Fermat. So we have a group of 9 individuals that specifically look at modeling these risks. So we use 2 different elements. One is external models. So there are, as I mentioned, third-party catastrophe models out there that are used to analyze the risk of each and every bond. We actually license 4 different catastrophe models. We are the only catastrophe bond manager out there, we believe, that issues all 4 of the available models. The reason for that, like any model, they all have their strengths and weaknesses and biases. You need to adjust for that. So we think it's prudent to own all 4. So that gives us our baseline view of risk. We then have our own internal Fermat risk model, where we combine all the third-party models into one view of risk, and that uses our experience. It uses our experience and our own internal tools to get to this expected loss figure, which you can actually see in this graph here. It's the middle row, expected loss. So what we're trying to do is just try and get as clear a view of the risk as possible. In terms of current market pricing, it's, as I mentioned, looking the best that we've seen in 21 years. So I just want to sort of build on that, because we have had a significant catastrophe occur, but the market dynamic was already looking quite favorable before Ian. You can see here in this graph, portfolio spread August to August, so again, before Hurricane Ian made landfall, had increased nearly 2%. The collateral return, so that is when we invest in these 1-month or 3-month treasuries, as you can see, that has gone up significantly too, nearly 2.5%. And our default rate has stayed the same. So expected loss went from 2.46 to 2.46 in the space of 12 months. So we're able to get nearly an extra 200% portfolio spread without increasing the risk. But one of the most interesting things about this slide here is that the max 1 in 100 year event loss We typically invest quite a substantial amount of our portfolio in Florida wind. Florida wind or Florida hurricane bonds are the best paying bonds in the market. So we were able to reduce our dependence on Florida wind. You can see that it went down to 23.2%. That's basically saying that we would lose 23.2% if a 1 in 100 year event were to occur. We were able to reduce that by near 6% over the course of 12 months, whilst increasing spreads at the moment. So, Manqing, what I'm trying to explain here is that the value of the cat bond market, or the valuation, so to speak, of the cat bond market was looking even more attractive pre-Ian. And as I mentioned, right now, it really is looking quite phenomenal. Spreads above 10% for our portfolio. Our spreads are above 10%, and the risk is still maintained.
So let's maybe take a deeper look into your strategy, GAM Star Cat Bonds. Could you give us an overview of some of the specs in terms of size and composition, average duration, and universe?
For sure. So this is our portfolio snapshot slide, I guess you could call that. This is as 30 September. As I mentioned, portfolio yield to maturity is above 10%, and you plus on the reference rate. So that could be in US dollar terms. I know we'll have a lot of euro denominated investors on this call, but US dollar terms, we are looking at a gross yield to maturity of over 14% right now. The portfolio expected loss is around that 2.3% that I've been alluding to. Our cash, we generally keep our cash quite low. For this UCITS strategy, we have been in the situation where it's been much in demand with investors, and I'll get to this a bit later. Right now, we're actually able to take on more money because there's going to be a lot of bonds issued. So we're essentially open. Our funds are open, where in previous years they have been soft close. And weighted average maturity, even though our interest rate duration is very, very small, these bonds do have a maturity level, and so they're either 2 to 5 years. Right now, we're at the lower end of the spectrum, so at about a 2-year maturity within the portfolio. And because it's a UCITS fund, we predominantly invest in the most liquid part of the ILS market. They are the publicly traded catastrophe bonds, and that's that second last row there, which is around 97%. It'd be remiss of me also not to mention that, as sort of discussed before, our largest risk in the portfolio is Florida wind or Florida hurricane. Right now, when we do our modeling, if a Category 5 hurricane were to hit Miami, our portfolio would be down, as per that last row, nearly 19%. So that's the big risk that you're taking on. This is a tail risk product. We are getting paid extremely well for that, taking on that risk, but there is the potential for drawdowns. I guess, looking at other asset classes, if you take that, 1 in 100 year type measurement, there are some bond funds out there that are down 10 to 20% this year. We know equities have been down at some points at 20%. So that's just to put into a little bit of perspective, but this is definitely, more exposed to Florida wind than maybe some other UCITS cat bonds that you will see out there in the market.
Could you give us maybe one example of a new addition or sale in your portfolio, and elaborate on why is that, to help us understand the logic, how you build up your portfolio, and maybe what kind of catastrophe modeling software you're using? Is it proprietary, or the development of the software they're using?
Yeah, so actually I'll give you a really recent example, and it actually occurred only last week. So we are known as the most active trader of catastrophe bonds in the secondary market. And so there's been many times over the course of our history that we've been able to actively trade around events. And so after Hurricane Ian occurred, there were some flood related bonds that started trading at 30 cents on the dollar, 40 cents on the dollar. The reason for that was that the market in general thought that they were potentially going to fully default if the flood losses reached a certain level. Our own internal systems and technology was actually pointing to a loss that was far below what the market was pricing in. So there were bonds in the secondary market, 30 cents on the dollar, 40 cents on the dollar, that we thought were money good. We thought were worth 100 cents on the dollar, or at least 98, 99 cents on the dollar. So we've actually bought those quite aggressively in the last few weeks. It's actually turned out that the losses are more in line with our losses, and they're going to actually recover fully. How we were able to do that, and to your second part of the question, was that we have developed a lot of internal capabilities to help monitor live catastrophe events. And so even though we've been an incredibly stable team over the years, the fastest growing part of our organization is our software developer team. So it's this box here in the bottom right hand corner. That software developer team has two real functions. One is to make our portfolio managers' lives easier. So it's about making the trading efficiency much better. It's about making sure that our operations team are also more efficient. But one of their other key jobs is to actually tap into technology to get a clearer view of live events. And so when this hurricane occurred and the flooding was happening, we were actually able to use satellite imagery, but also infrared technology to ascertain more clearly than the market what our eventual losses could be from that event. When we went through all of that satellite imagery, but also the infrared technology, which is really interesting. What infrared does, when there is flooding, it obviously happens from clouds. It's very hard just to see from simple satellite what the actual damage is below those clouds. So the infrared technology actually pierces through the clouds and can see, okay, where are the places that are flooded? Where is the damage? And let's see what the insured losses could be. We were able to use both the satellite imagery and the infrared technology to pierce through the clouds, see the losses were below, and we actively traded on that. And again, that's where we were able to get a bit of a rebound in our performance, and you can see that in October. As I mentioned, September we were down. It was our largest drawdown, September 2022. But one of our key philosophies is that we're active, and so from October, but also November, December, our investors will start to see the positive nature of those trades as those bonds return back up towards par.
Maybe I think for better research for our audience, there's a follow-up question to who are your competitors? You've covered a lot of, you've spoken a lot about what gives you an edge against your peers. So what differentiates the strategy from your peers? What's your main drivers of return?
Yeah, so it's really interesting. Our peers in the market, and there's more and more UCITS cat bonds that are coming to market. I think this market has historically been accessed by large pension funds and sovereign wealth funds, at least up until around 2011, 2012. Since 2011 or 2012, we've seen a lot more UCITS funds, bond funds created to cater for family offices, private wealth, those type of investors. So we've seen a proliferation of competitors in our space. One of the key differentiators, and I think I've alluded to it throughout, is that, and this may sound a bit strange on first cut, but please bear with me, we actually come from investment management backgrounds. So what we're trying to do is apply investment management techniques and skills into the catastrophe bond market, where we believe many of our peers may not be doing the same. Many of our peers may come from a insurance or reinsurance background, which is great. It's great at sort of looking through the bond documentation, modeling, etc. But they're not, we don't think they're as experienced or have the same models as us to build optimized portfolios. So if you actually look at our track record versus our peers in this graph here, where the blue line, our peers are the brown line, you can actually see that if you look closely, we actually have the same ups and downs throughout the history. So we are actually investing in very similar risks. What we're able to do though is, in normal times, but also around catastrophe events, is use our portfolio management skills and our investment management skills to trade around these events, which do happen each and every year. There's always going to be some sort of event that we need to trade around or make decisions on. You can see that divergence between us and the rest of the market from 2017 onwards. That has been quite an active period. We had 3 significant hurricanes in 2017. We had a significant wildfire in 2018. There were some Japanese typhoons, interestingly enough, in 2019. And of course, 2020 rolled around and there was COVID. And COVID actually affected some of our peers in the market, whereas we weren't affected. So it has been a really active period, but to be able to understand the underlying risk as well as possible, as I mentioned, using external models and our models, but also to be able to trade on that expectation is very, very important.
I think we've received one question from the audience. I guess what he meant is why was the return of 2012 and 2013 is 9%? What is necessary for it? I mean, why is that?
Yeah, it's a great question. So it's a well-known fact within our asset class that the best time to invest is directly after a significant catastrophe. The reason for that is, as I mentioned before, spreads skyrocket. So, to the person's question, we think that those returns will be actually exceeded in the next 2 years, all else being equal. And this graph actually shows the Swiss Re Cat Bond Index. We are loosely based off that index. And we've highlighted here all the significant catastrophes, both in the financial markets, but most notably in the natural sphere, and then also what the subsequent returns have been. So look at Hurricane Katrina. Hurricane Katrina is still the largest modern day insurance event that we've seen. It caused about $41 billion worth of insured damage back in 2005. If you actually inflation adjust those numbers, that's over $100 billion in today's dollars. But look at the 2 next years. Because of that spread reaction that I was talking about, you actually can get significant returns for 2 years after the event. So 12% and 15%. We believe that Hurricane Ian, or the market we're in now, is potentially slightly better than those Hurricane Katrina type investment conditions. The reason for that is that you can see here, spreads are above where Hurricane Katrina spreads were. We also have a higher collateral return as well. So again, all else being equal and not taking into account a significant catastrophe occurring, we think that next year we can get a 10% return. And we think the year after that, it could be even higher. Now, the reason I say that the second year could be higher, and look, you can actually see it in these returns here. The second year after Katrina was 15%, whereas the first year after Katrina was 12%. The reason that the second year is generally higher than the first is because you'll see some spread compression. So as spreads compress, we'll actually get a total return boost. We don't think that spread compression will happen until maybe late next year. The reason why spreads will come down, and they will come down eventually, is because we are seeing a lot of investors who are getting interested in the asset class. And to the question that just came through, they realize that now is a very good time to invest. There generally is. So for Fermat ourselves, we are seeing inflows from our managed accounts. So we have about 40% of our AUM in just 5 managed accounts. Most of those are looking to reinvest into this market. But we are seeing more new investors looking at the asset class now because of the return projections that I just gave. So it's quite a good time to consider investing right now.
So another topic that might interest many of investors, and particularly European investors, is ESG. How's cat bonds related to ESG aspects?
Yeah, so we're a little bit more tempered on ESG, even though we think that ILS are ESG positive investments. We are Article 8, so we are rated as Article 8 across our funds, which is fantastic. But we just think that the fundamental benefits of ILS are pretty hard to argue against. Our capital is providing relief to society in hurricane or wildfire or earthquake prone zones. And so one really interesting development, which I think typifies why our asset class is so ESG positive, is that the World Bank actually issues cat bonds. So they issue catastrophe bonds on behalf of developing nations like Mexico, Philippines, Peru. The reason they issue catastrophe bonds is because they know directly after a catastrophic event, that's when you need the funds. You don't need it many years down the track. Let's say that a country like the US may provide some funding to help after, let's say, a Peruvian earthquake occurs. That could take years to happen. Catastrophe bonds are fantastic because when an event occurs, you can get an immediate payout. So there was an example in Mexico a few years ago. They had a significant earthquake that hit around Mexico City. They needed proceeds immediately for hospitals, for rebuilding, for everything. There was a cat bond that actually covered that earthquake and it paid out immediately. It was within a month, and they were able to use those proceeds to start that rebuilding effort. So, from just a societal point of view, they're very, very positive. You can see here, looking at the UN SDGs, there's a lot of alignment between ILS and the UN SDGs. So if you look at, number 11, for example, sustainable cities and communities, and the actual wording is sustainable decrease direct economic losses relative to global GDP caused by disasters. That's essentially what catastrophe bonds are doing. We're looking to reduce the stress that a catastrophe can cause on economies, but also on society itself. In terms of us and ESG, we are a UNPRI signatory, so we have been a signatory since 2011. We've actually been rating every ESG bond, every cat bond in our market on an E, S, and G basis since 2014. So I know it's been very much a huge growth area, ESG in Europe and in Asia and Australia. We've been looking at ESG for several years now, and we are taking a bit of a leadership role in the asset class because we are the largest ILS manager, and I know we have a lot of, power within our asset class. We want to try and use that power in ways that can, grow our market, but also improve the quality of our market. So we have been involved in efforts in Congress here in the US to try and get more people issuing cat bonds. The more that cat bonds can be issued, the more protection we're going to get. And that's a long-term goal of ours. So we'll wait and see. We're trying to push a certain bill where we need Democratic and Republican support. As you may know, it's very hard to get those two to agree, but we're getting there. We're getting there slowly.
Okay. So would you shed light on the outlook of cat bonds offerings in terms of issuers type and region? You talk about new regions like Mexico, developing countries. Where do you see opportunities in growth?
Yeah, so our portfolios, and this shows essentially our asset allocation for our GAM Star Cat Bond Fund. You can see, Florida Wind, FLW, is our largest risk. If you actually go around the pie chart, you'll notice that many of our risks are US-based risks. We love US risks, and this is probably a differentiator versus some of our peers. We love US risks because, one, our capital is most needed in these US risks. Those cities like New York, Texas, in and around California, those cities are growing much faster than the insurance companies can keep up with. So they're willing to pay much better spreads on those risks. And also the modeling is far cleaner and clearer and scientifically backed in the US. And so that's why you see this US focus. Looking forward though, and this one might be a little bit left field for some of the people I called, we do believe that cyber ILS could be a new frontier in our asset class. And it makes sense. The reason why catastrophe or natural disaster risk is so prevalent is because everyone's congregating in the one city. It creates all this risk that might get hit by a catastrophe, and that's why our capital is needed. But if you think about cyber, what are we doing right now? A lot of us are actually congregating on the same systems. If you look at cloud computing, there's Amazon, there's Microsoft, there's Google. We're all at least a part of one of those, which creates these big pool of risk. If a cyber attack were to hit those, even though they've got some great systems in place, it can cause a catastrophic level of insurance damage or business interruption damage. So we believe that we'll start to see more cyber ILS being issued to help insurance companies, but also corporations like Amazon and Google protect themselves from cyber attacks. The modeling, we think, is getting up to scratch. We've been looking at cyber ILS for 5 years now. We haven't invested. We're very, very slow and steady. But I'd just say to those on the call now that It's something that we're looking more and more closely at. The pricing is looking incredibly attractive. The modeling, we think, is really getting there. We have a specific cyber model too. So I wouldn't be surprised if we have a very, very small allocation within this portfolio. To put that in perspective, I think it could be 10 basis points. So 0.10%, but still, I think a really interesting one for those on the call to understand that we do think that could become a peak risk within our asset class within the next 10 or 20 years.
It's very interesting. I didn't know that cybersecurity also would categorize as a natural disaster. I mean, I hope it didn't touch upon the crypto thing.
No,
the risk and everything. It gives whole new perspective on this asset class.
Exactly.
What type of investors should be looking at cat bonds? Is it just an institutional products? What's your mix there?
So for this strategy in particular, when we launched it back in 2012, we actually have around 85% in, let's call it, wholesale type investors. So that's family offices, financial advisors, investment consultants or smaller investment consultants. So most of the investors are actually non-large sovereign wealth funds or pension funds. As I mentioned at the start, historically, ILS and cat bond investing has been predominantly the domain of the large sovereign wealth funds and pension funds. It's how we got our start. We had just a handful of larger clients, but now we are seeing more and more other investors invest, and it really is because of that elevator pitch that I said at the start. Yeah, you don't need to put a lot of your portfolio into something like this. We understand that the educational process can be long, but the diversification benefits and the spread available, I think personally, and I'm obviously really biased, makes sense for any investor. And I know it's actually a long-term goal of our co-founders is trying to access, or at least give the opportunity to all investors out there to access this risk in their portfolio. And we're slowly trying to get there.
So to wrap up our discussion today, what has been the biggest challenge in managing portfolio this year for the team? What is the biggest tail risk on the horizon that investors should be mindful of?
Yeah, so the biggest challenge this year was Hurricane Ian, for sure. It was our largest drawdown, and because we do have a larger weight to Florida, it meant that we had a quite a significant drawdown. The loss picture for that is looking much clearer. So we think that 6% drawdown that we had in our portfolios will only come to a realized loss of around 2.5%. So despite how sad I get about the drawdown, it may only come out to around a 2.5% principal loss to our portfolios. So that's something that we definitely need to get out to investors and explain to. Now, the largest tail risk within our portfolio is, again, Florida hurricane. Going back to this graph, the max 1 in 100-year event loss. So again, it's a simulation of a Category 5 hurricane hitting Miami square on. That has been our largest tail risk in the portfolio. But more recently, as I mentioned, we've been able to reduce our reliance on Florida hurricane even before Ian, and still increase portfolio spread. So yeah, it still is our largest tail risk in the portfolio. It will continue to be. But for investors considering this asset class, they're not having to have a 30% allocation to Florida wind in their portfolios. It's lower than that. So that is our biggest risk.
So a big thanks to you, Tom, for sharing your thoughts with us today. Thank you for joining us.
Of course. Thank you very much. That was fun.
So I hope you all enjoyed our Portfolio Manager Conference today and leave better informed. All right, then have a wonderful day and see you next time. Thank you. Bye.